JBlog, 2nd of January 2011. 2011 has arrived, and we're ready for another year of fun and excitement in the markets. So, starting at Market Watch, of course, we have big picture of the bull being greeted or greeting 2011, and according to the um, most investors, 2011 will be amazing. It will be straight up and everything will be wonderful. But there are voices that don't agree with that picture. I am, of course, one of them. I have been bearish for a very long time, too long probably, but 2011 might very well be that year that the Fed and the government and everyone else will run out of rabbits to pull out of that hat, and the mess that they've made over the last few years will become apparent. The mess that is, of course, passed down to our children and grandchildren from this point on. The total bankrupting of the United States as well as a lot of Western countries. See how that all goes. But I've said before that you cannot spend your way out of debt, and I'm still of that opinion. Looking at a picture of the S&P 500's P ratio, um, currently running at 22.96. It touched 23 the week before the new year. The rally towards the end of the year was definitely very impressive. Fear seems to be non-existing, and the markets have just been running up like crazy. Very impressive, no doubt about it. TED spread is looking a bit of a bounce. This is not the chart I was looking for. There's a bigger one here. Um, Maybe this is the one. Hopefully this is the one. Yes, TED spread. TED spread is the interbank interest rate that banks are charging each other. It is still quite low, but it's on a possible uptrend here where banks are starting to get worried about their each other's holdings. Again, they don't know what each other's holding, so they don't want to lend a lot of money to each other just in case. The Baltic Dry Index is also continues to decrease, which continues to say that less goods are being shipped, or alternatively more ships are available, and therefore prices keep going down. There's arguments on both sides of that equation. Um, Interesting article I came across, the S&P Chase Shiller Home Price Index. Of course, home prices topped out in 2005. That this dreadful drop bottomed in 2009. In sync with the stimulus packages have been increasing since then and are once again dropping now in 2010 because most of the stimulus packages are gone, and it is no longer just subprime holders that are in trouble. It's actually prime mortgage holders that are starting to be in trouble, because prime just means you are employed, and with a U3, U4 unemployment rate of almost 10% and an actual unemployment rate according to U6 of more than 17%, you cannot have 1/5 of the US population being out of work and not have it an effect on home prices. That is silly. So home prices are dipping again here. There's some interesting stories out on that one. I'll get to them in a second. I was talking, one of the pieces I wrote was on municipal bankruptcies, which we'll probably see more of this year. There was a federal aid package to states to allow them to meet their payrolls for 2010. That aid package has run out now, and this talks about the number of bankruptcies there were in history. Last year, up until June, there was only one. That is, of course, ridiculously high. We're going to probably see a larger number in the future in the next year on that. Big story of 2010 was, of course, the run up in commodities. Everybody loves gold, everybody loves silver, everybody loves oil. Here's a long-term chart, 20 years of commodity prices according to the CRB index. There was a huge run up here in until the middle of 2008. Then there was a gigantic drop, and there is a recovery. This is nothing special here when you think about it. All this is a reversion to mean because we're basically back where we were in 2006, roughly. There was still this run up, and of course, that run up was caused by the easy money that was to be had, not just from the Fed, but also out of Japan and many other places, as well as the emergence of China and adding, with India adding over 2 billion, sorry, 2 billion new consumers to the market, who of course all want cars and all want refrigerators and all want the good life that we have. So that is clear that commodities have to go up under these circumstances, but like everything else, always overshoots and then it comes crashing down, just the way it seems to go. Um, on a day-to-day basis, oil has once again hit a channel high right here. This channel has been intact for 2/3 of the year. So oil is potentially due for a pullback if history repeats itself. And it's not a very good, very clean channel, but potentially oil is a little bit on the expensive side here. Natural gas was dropping just a couple of weeks before Christmas. I've been betting a bit on natural gas. I believe that natural gas is unloved at this point, and this winter is turning out colder than most people expected. So I bought a bit of natural gas, and that is starting to pay off. Right here, I like that. Gasoline prices, of course, are totally out of whack. Um, and that is going to hit consumers in the pocketbook because every time this number goes up, consumers have less money to spend on other things, especially in the unemployment situation that we had been talking about. Now gold, I had observed that gold, we have a few technical divergences here. The RSI is coming down even though the price is going up. Now that the trend line I had on here was slightly violated towards the end of the year. We'll see where that goes. Gold can easily drop to 1270 and still be well within the realm of an uptrend, an unbroken uptrend. I still think gold got a bit ahead of itself, but then nobody knows what the US dollar is worth and nobody knows what the euro is worth because we simply don't know how many there are. So it's kind of a crap shot when you're trying to take a measurement and your measuring tape is made from rubber. Silver, the big performer for this year, obviously. I mean, this is an amazing run up. There was some talk of a short squeeze on JP Morgan, who supposedly had been shorting the silver market for many, many years, and maybe they have finally capitulated on that move. It wouldn't surprise me because this run up is, I don't think if you short this, this run up is sustainable. Now, gold silver ratio is still within this channel, so everything is still on track. Nothing has changed here, but the actual ratio that those two come out of the ground is 1 to 16, so that ratio which should still be somewhere around 1 to 16. So silver is still undervalued compared to gold, highly undervalued compared to gold. And if you do believe in the precious metals, then silver is a better investment. But of course, silver is violent. Um, Gold in euros, as a comparison to gold in US dollars, is still very much in the uptrend. Has touched this trend line quite a few times now. Seems to be a pretty reliable uptrend, so that indicates to me that Europeans are printing money just like Americans are printing money. There's no difference really between the central banks. They have to print money. There's no option. Otherwise, they're just going to go bankrupt. Um, this is the US dollar. I'd been betting on the US dollar going up, but that has been a bad bet as of late. The US dollar is once again dropping towards the end of the year and has violated this uptrend line. The one that gets me is the VIX, continuing to have no risk. This market is not worried about anything going wrong. The VIX continues to go down. We have little spikes that go up, but nothing. There's just no fear in this market, which is just amazing to me. I'll talk a little bit later about that. Copper has made new highs. Of course, copper is the um, the metal with the PhD in economics, and anything electrical needs copper. And of course, for anything to move, it has to be electrical. So copper is a good way of telling whether the economy is actually growing on some part of the world or not. Now, there is a side story to this. Right now, there's supposedly one trader or one group of traders that own over 90% of the copper futures. Somebody making big bets on that this will go higher, and that could, of course, turn nasty. Barings Bank comes to mind, somewhere in the 80s, a big bank, trading bank that went bankrupt because one trader bet on copper futures too much, and the rest is history. It's the 3-year chart of the New York Composite here. Pretty flat except for the last 3 years. Um, and yeah, that's basically the year in review. Now I've got a better one of that. Last 10 years in review. This was basically right up here. This was the 1st of January at 2000, the year 2000, and of course 2000, 2001, 2002 were bad. Then we had 5 good years. Now we had one bad year, um, and then we had 2 good years. This was basically this year, but most of this was done in the last 3 months, ever since Bernanke started talking about QE2, and really not justified. QE2 isn't big enough to bring about this kind of a change. Uranium continues to look good. China and India continue to buy uranium. It's that simple, and the price will continue to go up. I don't see a reason why not, unless those two countries want to go out of business. Option speculation is at an extreme high right now. These are naked options for the most part. This basically means that there's a ton of speculation of unsophisticated investors in the market speculating on this thing to go higher. Um, and then there's an interesting chart I came across, which is the Great Depression versus the Great Recession chart. So this one here is the 1929 to 49, and this is the 2000 to present chart. And it's interesting how the two are really very closely aligned, and if history repeats itself, this is basically the point when we're looking for another downturn, um, time-wise. And history does not necessarily repeat itself, but it does echo. Now here is a dark horse that a lot of people are still not aware of: the indebtedness of Japan. This is gross financial liabilities versus GDP projection for 2011. Japan sticks out like a thumb at 200% GDP, enormous. And the Japanese population is aging. There's unlikely to be a lot of growth there. So this will blow up eventually. There's a big threat here. Nobody talks about it. A few articles on debt collapse in Europe, which could be ugly because all of these debts are tied to each other, and it could be quite ugly if they do collapse. A warning that airline traffic might slow down and profits might drop by 40% in 2011. Um, this is an interesting statement of a Japanese, formerly known as Mr. Yen, who basically is puzzled about why the US is trying to do the same thing as Japan did in the 1990s and 2000s, seeing that it didn't work. Of course, here we have the reason why, not why, but a story about how Goldman continues to make millions in terms of payouts. The officers of Goldman. It's a very interesting article on how some are very benefiting a lot from uh, the current economic situations, while a lot of people are definitely suffering from it. Again, another Wall Street story that talks about bonuses and how there's many little guys that are not making money on Wall Street these days. Also very interesting. Big guys, forget about this one. Single T is the one about single trader holds 90% of the futures. And then there's some warnings um, uh, coming. This is the sentiment I was talking about. The point is that when um, 60% of more investors become bullish, which is currently the case, 58 to 60% of investors at this point are bullish and only 20 or so percent are bearish. These are the extremes that usually flag atop of the market when everybody becomes bullish and everybody has bought and nobody is selling anymore. That's usually when things turn around. There's a few people that do call for some trouble in 2011. I'm one of them. I continue to be one of them. But of course, until the US and the rest of the Western world runs out of credit, this bubble could continue for a long time. 2011 could very well be a some changes coming, so do continue to protect yourself. I wouldn't step out on a ledge too far at this point. Prudent lifestyle and prudent investing is probably advised. Anyways, all the best. Good luck next week trading and make lots of money.